So the special topic of this session is rather on distressed LBOs, distressed firms, and how to handle the problem of LBOs which don't work so well. So the panelists, we have the chance to have panelists who are specialists of this topic. So I will present them very briefly. I won't really present what they are doing because I think they will do better than myself. So to my right, just to start this way, David Shivner. That's a wide way to pronounce it. Very difficult. Well, it's very difficult to present also because he speaks almost every language, I would say, and he learned in any country almost and works in different places. So he's now partner at Wild Godchild Manges. That's the way you say it. And so this is a law firm which is very important, in particular in the United States, and also now operating more and more, I think, from what I understood, in Europe. Well, actually, two people are from the same firm here, and maybe more in the States for Shay Weisman, and maybe more in Europe for you. Okay. So this firm is one of the most important, and from what I understood, you took care of the case of Enron, WorldCom, you in particular, so very big deals in the States and also in Europe. And then, we have Guillaume Brémond, who is in a French law firm. He's an associate at this French law firm, so he's specialized also in restructuring, mergers and acquisition. I present the firm, I think, later on. And then we, from a different perspective, somehow different perspective, Jean-Louis Grevet is from Butler Capital, which is a capital firm, not a law firm in this case. And they invest directly in turnaround deals. And they were involved in important deals from what you can see.
Good afternoon. My name is Shai Weissman. I'm a partner at the law firm of Weil, Gotshal & Manges. I'm trained and based in New York. And David, who's on the panel, as was mentioned, is a partner in our Paris office. The firm generally, we are now at 18 offices, 1,300 lawyers worldwide. I think well over a quarter of our attorneys practice outside the United States. And we, among our many practices, two that we are very well known for are our private equity practice as well as our restructuring practice. We have represented most recently in restructurings WorldCom, Enron, Global Crossing. We're involved in the Parmalat situation, just to name a few of very recent vintage. I myself have practiced exclusively in the restructuring area since 1996 and have been involved in a number of large domestic, U.S. domestic restructuring matters, including failed LBOs, and currently represent Loral Space and Communications, a very large satellite manufacturer, in its restructuring. I've also, on behalf of parties, purchased many distressed assets out of Chapter 11, the U.S. insolvency law, including representing American Airlines in its purchase of TWA a number of years back.
My name is Jean-Louis Grevet. I am a partner from Butler Capital, which is a fund specializing in turnaround. So two things: we're a fund, which means that we are in the fundraising business with institutional investors. We have currently 15 shareholders, primarily from Europe and the US. And the second thing is that we are investing not in LBOs. We have been doing LBOs in the past, and currently we're focusing, I would say over the last 5 years, we have been focusing on turnaround situations. The most recent deals, we have a focus only on France. Currently, the most recent deals were France Champignon, which is a deal that was under the CEFI in the CEFI process over the last 6 years, and we recapitalized the company during the summer. Another deal we completed recently was the purchase from Baku Dalloz of a company called Abrium. Earlier on, we recapitalized two quoted companies, César, two companies quoted on the second market in Paris, César and Group Flow. And we are currently restructuring a buyout that had been distressed over the last 2 years. I cannot give the name.
Good afternoon, my name is Guillaume Brémond. I'm a partner at Vailjourde in Paris. We're a law firm pretty much specialized in M&A deals. As far as I am concerned, I am more specialized in turnaround deals, as my previous experience has given me specific competencies in that field. I've been a partner at Sony & Partner, which is the small, very specialized law firm in Paris, and then I was on the investor side as I worked for Groupe Arnaud for 2 years in investment deals in especially venture capital, in a context which has led to be first doing investment, then turnaround. And when I went back to the lawyer's side at the Vailjourde firm, I naturally specialized in turnaround situations. And as we have seen the evolution of the market, we have been doing more and more turnaround deals in LBO situation, either in LBO as the investor in turnaround, or LBO situation turning not as good as expected by the initial investors of the LBO, and we see more and more of those situations. So our situation of a firm specialized in M&A and in LBOs puts us in very specific situation, able to help investors and company faces turnaround situations today.
Good afternoon, I'm David Chiner, and I'm one of Shai's partners, as he said, based in the Paris office. My practice is split between doing deals on the one side and on the other hand dealing with deals that have gone wrong. On the deal side, the most recent LBO I've completed is that of Materne for Hicks Muse. On the troubled companies side, I've been doing a lot of restructurings recently, if only as a result of the economy. And those restructurings have involved in particular two areas which may be of interest today. One is I've had the good fortune to represent clients in a number of LBOs that have gone wrong. I'm thinking specifically of the Georges Resch matter that went wrong, a troubled LBO typically. And I'm thinking also of the Valiance matter, which in a sense epitomizes what I think is the current trend, and to some extent brings us back to the type of remarks that Jean-Louis was making, in as much as on the one hand the entity that went wrong was itself an LBO, and on the other hand the party which I represented and who was bidding to restructure it was a firm of specialized investors that were treating investing in these types of situations very much as a private equity transaction, and were using all of the various techniques that are classical of private equity in structuring that transaction.
Well, first one question for, I would say, all of you. Did you see more distressed LBOs recently? And I don't know if it's good news or bad news. Do you predict more and more distressed LBOs, or things are going better?
I could start with it maybe, and then yes, of course, there have been more and more LBOs in difficulties for one reason. There have been more and more LBOs in France in the last 10 years. So the presence of financial investors in France and in French businesses makes it that more and more companies that are facing difficulties are companies that have been the object of LBO previously, first. And second, many of today's investors are LBO funds. So it is impossible to miss them in the business. So yes, there are more and more LBOs facing turnaround situations, and that doesn't mean this is not a bad news. This is only the evolution of the economics of the business in France.
I would agree with what said Guillaume. As a matter of fact, maybe I will give you some feeling about our own experience about that. Is that until 18 months ago, we were not seeing many files, many deals concerning distressed buyouts in the market. And since the early 2003, we have been receiving many new files. And I think it corresponds to when you look at the pattern of fundraising in France, many funds were raised in between 1998 and 2000. If you add to that the time to invest money and the time for a business to fail, you come to 2004 and 2005. So we expect, obviously, in the next couple of years, a number of buyouts to suffer. I don't know if it's a good news, because obviously we need a strong and profitable buyout market. But as Guillaume said, that's the story of the economy, and there will be buyout failings. And the good news for the entrepreneurs and the managers is that there are investors ready to restructure these buyouts, either the existing shareholders or new shareholders.
One of the interesting things we've been noticing, and that to some extent goes in the same direction as what Guillaume just said, is not only are there more LBOs, but typically over recent years, we have seen the private equity community do LBOs in circumstances where typically they wouldn't have done them 10 years ago. That's item number one, and where they've been doing more than simply just taking a company and putting some leverage in. And a lot of the failed LBOs or troubled LBOs that cross my desk certainly involved failed build-outs. I mean, a high percentage of them is typically a private equity house buys a company in one area, decides to buy a number of companies in a similar area, and beyond taking a company-specific risks, takes on the risk of whether or not it will manage an integration. And certainly in my experience, a very high percentage of troubled LBOs involve LBOs that have an additional risk element, such as the one I've just described.
I'll just say generally, I mean, there's a reason we have this presentation, restructuring an LBO. By their very nature, when you structure the LBO, you want to maximize return to shareholders, so it's going to be a highly leveraged transaction. Based on projections, and I think we all are very aware of the fact that projections are art more than science, and inevitably there's going to be a hiccup, and you're going to need to restructure an LBO more than your traditional transactions.
Well, I had a second question about what are the causes of these failed LBOs, but you almost already answered. Well, it's just because we have more LBOs and also maybe more debt and things which would have been financed through an LBO of private equity would not have been financed this way previously. So maybe just some point remaining in my questions. Well, it seems by listening to you that the LBOs that didn't work out, finally, in the turnaround deal, the business will be going on. So my question is, what's the percentage of, your impression of the percentage of LBOs we were bad projects, opposite to, good projects, but maybe which were financed in a too risky manner, but okay, the good intrinsic project.
Just not to answer your question, but because it's a very difficult question, I don't think there are statistics as to exactly what are the causes of the failure and what the way out could be. But just there need to be a distinction as to the causes of the failure situation of the LBO. As Shai just mentioned, it is true that one of the reasons of some LBOs being in difficulty is the level of leverage, and that is to say that maybe the company that has been the subject of the LBO is still making money and going well, but it doesn't pay off enough cash to reimburse the debt. And that is one situation where the business itself is still worth investing in, but the problem is on the debt. There's a second situation where the business itself faces troubles, and the difficulties are much deeper, and it's a different situation, and the ways out are different. There will need to be more restructuring business on the business itself than just pure debt negotiation.
Yeah, maybe I will add one point, sorry about that, to what Guillaume said. It's right. However, you know, when you look at the distressed buyout, that's our perception, and obviously anyone can have a different perception, obviously. You cannot tell yourself, you know, you just fix the debt issue and don't bother about the operating issue. That's absolutely not the way we look at it. You have to look at both, and because we are in the business of maximizing values, and very often, you know, and I think we'll discuss it later, it relates to the management. A management that has driven a buyout into a distressed situation has lived the trauma, and you clearly need to refocus and re-engineer the company to also on the operating side, to concurrently to fixing the debt. You have the two aspects.
No, absolutely. And frankly, in this jurisdiction compared to other ones, historically the community, the financial community, has been relatively conservative with respect to the amount of debt that it's been putting in leverage buyouts. So perhaps more often than elsewhere, where you have an LBO that runs into trouble, you have more than simply a small turn in the cycle, resulting in somewhat less cash flow and in servicing problems. I mean, those are relatively easy to fix, as Guillaume was pointing out, but very often when you have a troubled LBO, you have trouble that goes beyond the mere amount of debt.
There's always a cause and effect problem, because in many LBOs, when the business itself faces some situation where the cash flows are not sufficient to pay off the debts, for a certain time, we will take all the cash from the business and make it impossible to have the necessary investments made, and then it has an impact on the business itself. And one of the key elements, and one of the hardest things in LBOs facing difficulties, is the time frame under which the management of the business and the management of the fund will realize that there is a situation that calls for specific measures to be taken rapidly. And the more rapidly you take those measures, the more chances you will have to fix the situation. And this is not an easy thing to admit for people who have made the investment, have told the investors that we're going to make a lot of money out of it, to realize and admit and communicate on the fact that no, it's not going to work, so now we need to do something else.
To come back to your answer, well, in the case of operating problems, and as a fund, you take a share in this company, and probably you make some changes, I suppose. What is the advantage of being a fund rather than a company in the business, for example, in the same business? I don't know, are there any advantages and drawbacks?
I will say what I see from takeovers that have been made on turnaround situations. You always need money, but you also always need hands-on investors that have a specific knowledge of the business. Otherwise, a pure financial investor will probably not be able to cure the problems that the company has faced before. And it is very important to have a team of A, financials, and B, operators knowing the specific business, to make sure that the necessary restructurations will indeed be made, to make sure that you have really seen where are the values in the company and what are the risks of the company. So you cannot say that you need to be a financial investor or you need to be a pure operator. For turnarounds to work, you need to have both.
I absolutely agree, but I don't know that in today's world you really can say that there's much difference between a strategic and a financial player. I think it comes down to the fund. And if the fund identifies appropriate management. Hopefully it's somebody who understands the industry and perhaps has connections in the industry, and is proactive enough to recognize problems as they arise and implement changes, and as well advise the fund of situations that it sees out into the future. So with today's sophistication, I'm not sure it's really the difference between a strategic or financial player. I think it's more the level of involvement of the fund, recognizing and appointing appropriate management and management activism.
There's one French specificity in this area, and I agree with both speakers that clearly funds without management or the reverse doesn't work. It's where you push things to an extreme. Now, once you end up in front of the Tribunal de Commerce, and the question becomes one of either a court-sanctioned restructuring, call it a plan de continuation, or an asset sale plan, a plan de cession, the court has to review you according to 3 criteria, and one of those criteria is going to be to what extent does the offer which you file provide the underlying enterprise with the best chance of long-term survival. And that's where funds really have a credibility gap, which when they choose to file, they have to work very hard at, because by its very nature, a fund is self-liquidating. So a fund that chooses to play the game by going all the way to the end and show up in front of the court has a bit of a handicap compared to a company in the same sector that has a very easy time convincing the court that it's here tomorrow, and if it depends on it, it will be here in 20 years' time. So that's one area where funds are at a bit of a handicap. The so-called evergreen funds, and there are a few that invest in this business, have a structural advantage there, but the best advantage is a company that can point to the fact that it's its core business, because it's got immediate credibility with the judges.
Obviously, I'm not in total agreement with what David just said. I think it's difficult to draw general rules about this business, and I think we need to expand the discussion not only about buyouts but about turnaround in general. It's extremely difficult to determine whether a strategic buyer, even in court situation, has a strategic advantage over funds. There are a wide variety of reasons. First, in the decision-making process of the court, then in the decision-making process of the managers. I would say the people having the hand on the process very often are the managers within the company, which is good, I think. And then there is the need at the level of either of the strategic buyers of the fund of having focus on the situation. So it really relates to a matter of people and the way people have the perception of the situation at a certain point in time. And I'm not in a position today to draw a general rule about that. What I would say about funds, first, there are very few funds doing that, and I think it will change, and we will discuss that later on. But for the time being, there are very few funds in this business. The main, we are financial investors, and we are not managers. We are not running the companies. There are some players in this market and in some other market sending managers within the companies to run the businesses. That's not our philosophy. Our philosophy, and what our shareholders are asking us, is to have a judgment and to make a decision about managers. And so it's really the key element for us is whether you establish a proper decision-making process and frame of discussion with the management team. And here I think we can make a clear distinction with buyouts, is that typically today in an auction process, funds would meet the management 2 to 3 times or 4 times in management presentations, and because it's really an auction process and you need to make an offer quickly in a certain time frame for buyouts. Well-run buyouts, and in turnaround situations, you're really building the business plan and establishing, the turnaround plan with the management team, because there is limited competition in this market today. And the way we are looking at it is to have the time to build the proper plan with the management. And for example, just to give you an example on France Champignon, it was an 18-month process between the time we started to look at the file and the time we put money in the company. It was 18 months. During 18 months, I can tell you, you see all the mistakes. And the management is not going to tell you things that you don't want to hear about later on when you've put the money in the company. So I would say the whole process of putting together a turnaround for a fund is totally different. And in certain instances, my experience, but which could be different from others, that we have, in certain instances, when you establish the proper pattern with the management, a clear advantage over strategic buyers.
Maybe to go back to your point, you have a specific strategy which is for well, not the same, but similar for all turnarounds, or like, I don't know, how much share of the company do you take, and who are the other shareholders, or does it differ from company to company?
We tend to take the majority. So it's either 100% or above 50%, and we give a slice to the management, obviously, and we tend also, and the philosophy is when we look at the existing shareholders, either we have within the existing shareholders supporting shareholders that support the plan, that make our life easier in the future, and we'll tend to give them a nice slice of the cake, and other shareholders that want to exit and pull out, and then we have to take the picture at that time and put a price.
I think it's very important to make the difference between the situations and the time why the investment should be made. If we are talking about investments made in companies in out-of-court negotiation, in what we call in France prévention, mandat ad hoc, conciliation, for the buyer, it is pretty much like a common investment. It doesn't have that many specificities outside the fact that it is a turnaround, so you need to have a precise idea of how you're going to restructure the business and make it profitable again. It is very different when we are talking about buying assets or buying businesses in court. And there has been a very good example of those specificities and the kind of problems you might be facing. You were talking about Valiance, which you worked a lot last summer on. In Valiance, you were presenting a bid for a very good candidate, an American fund specialized in investing in turnaround, making a team with a French manager with a good experience in the business, not exactly the same business, but something very similar. And as the opposition was on another bidder, which was Securitas, obviously a player, a competitor on the same market. And you could have had two positions taken by the court. They could have considered that it was not safe to give the business to the direct competitor, as he could have an interest in just closing down Valiance and taking the market share. On the other hand, and that was the position taken by the court, and they considered that the American fund plus the French manager didn't give as much visibility to the business, and that it was for them, in their perception, very important to have an existing player in place to make sure that he had seen exactly the causes of the difficulties and that he would be able to put the business again on the profitability side. And this is always the balance that has to be made by courts, and I agree with Jean-Louis that things should be changing, as some funds in France, not many, but some funds in France now understand how it works and may be able to build solutions even for bankrupt companies, and to explain this to even before courts.
But, Thanks for raising the Valiance point. I mean, the issue was slightly different, though, because Securitas was not present on the French market. It was present doing the so-called gardiennage, which is keeping an eye on buildings. It was not present in fund transport. So the competition issue wasn't there, and on the contrary, France was perceived as, quote, strategic for the world leader in the area. And the court, when the balance came down, and that's one of the interesting points, rejected an offer from a fund backed up with very credible management that was offering to keep more jobs and was offering more money, simply because it felt more comfortable, as you were saying, with the visibility of having the #1 company in the sector. And that's one issue where, in a sense, when a fund goes to the very tail end of the business, which is buying these companies out of court in an insolvency, one of the things you have to address is how can I build up my credibility as a long-term investor who will build up the business which I'm taking over to be a long-term viable undertaking, a long-term entity that contributes to the community. And that's the court's key concern. I mean, earlier, Patricia and I were chatting, and she pointed out to me that not that long ago, she'd read an article to the effect that most companies that go into an insolvency process and are turned around eventually end up in insolvency again. That's the one nightmare which the judges have. The judges want to know when you go through an insolvency process that they've done their very best to ensure that they've imposed some sort of long-term solution. And the key when you're a fund and you go to the court-based end is how do you present yourself in front of the court as a credible, long-term, viable alternative that will invest in this business. I'm not saying it's impossible. I'm not saying that every fund is not different. On the contrary, I think those things happen already, and I think they will, more and more of them will be happening. But I think there is a pedagogical task when you're showing up today in front of a French court. Now, where, as Guillaume rightly pointed out, things are totally different, is when you do things in a mandat ad hoc, the so-called pre-insolvency. In a pre-insolvency, in a sense, you never deal with these issues. You deal with a sponsor that simply does not want to sully its reputation by having a very messy French insolvency on its hands. And you deal with banks that also have concerns. And under French law, lenders have far more often a variety of liabilities that we don't have to deal with in other jurisdictions, or at least that we deal with to a lesser extent. So when you're dealing in a mandat ad hoc, actually I suspect, and I'm sure Jean-Louis will be able to contribute on this, you may as a fund actually have an advantage on an industrial business, because what the people are looking for in a sense is a pure financial reasoning. They're looking to a financial solution from somebody from their community. So it's, in my view, it's a funny mixed version where being a fund has got advantages at one end of the spectrum and inconveniences at the other.
From the United States perspective, acquisition of assets out of an insolvency was something that was really unheard of for many, many years under American bankruptcy law history, and it was really only in the early 80s that courts started to recognize that you could come into a Chapter 11 case and buy out all of the assets. But it was, bankruptcy has long been considered, the junkyard of American businesses. So while the court said it was okay, it was very rare that anybody would venture in until a number of strategic players realized they could acquire assets very, very cheaply, because you don't have in bankruptcy, you don't have the auction process that you discussed, which often raises the price, and you come in as a sole bidder, maybe competing against one or two other players, and you're able to acquire the asset, and in American bankruptcy law, leave behind all of the liabilities that you don't want, which I think very much unlike the laws here include pension liabilities, retiree benefits, burdensome contracts, litigation liabilities that you aren't really aware of yet. It took a long time, and I kind of compare it perhaps to what's happening now in the French courts, for courts to become comfortable with these types of transactions. But we've now gotten to a point where it's really the financial players are now wading into bankruptcy much more frequently than even the strategic players, and are acquiring assets more opportunistically than ever before. And you're seeing, Wilbur Ross, most recent example, purchased 5 steel companies out of bankruptcy, left behind $20 billion in liabilities in the bankruptcy court, purchased the 5 steel companies for $2.5 billion, and 3 years later has sold them for $4.5 billion. It's a pretty nice return in 3 years. So I think, LBO funds are participating. We've also seen private equity funds now come into the Chapter 11 process, and not much surprise to anybody, the hedge funds in the last several months have also become very, very active. I wonder if you think you'll see that here.
Probably one day, and coming from the States, certainly difficult to say today. Two comments maybe. The first thing is that, coming back on what you just said, is that I think the situation of banks in France are fairly different from the US situation. I think the court process for banks is a nightmare in France. There's 3 issues, what we call gestion de fait, which means that if the court decides they've been actually managing the company, even though they were not shareholders, they could be liable and put additional money within the company. Then you have what we call the rupture abusive, which means that if they cut their credit lines before the bankruptcy, they could also be liable, and vice versa. If they put additional money, they could also be liable. So it's a nightmare for the banks, and it is true concerning the remarks of David that many banks are pushing to treat the issues under what we call mandat ad hoc, or conciliation, before going to court, to prevent from these situations. And obviously, it makes our life sometimes easier to restructure these companies and avoiding the auction process of going to court. And because when you are in court, it's a sort of auction process. The other comment I wanted to make is that the courts tend to, when you are in court, I think the only focus of the judges, that's my perception, and is the social issues. They want to have people in front of them to save the employment. And what is true, I think, is that from that perspective, for a fund to get an asset against a strategic buyer on that front, is that you demonstrate clearly on past deals that you have been able to treat properly the workers. And when you talk about turnarounds in France, unfortunately, you have to talk about social issues, the way you carry what we call plans of sauvegarde de l'emploi, layoff programs, the way you are recognized by the workers' councils, by the consultants like CEFI or Syntex, which are used by this workers' council, and you need to build with those guys a credibility, like you need to be credibility with the banks or with your shareholders. You need to build credibility with those guys. And so from that respect, for people who have not built that track record yet in front, I think they are today and I agree with you, at a disadvantage in this market.
Well, from the discussion, it seems that it's the regulations are very important in this subject. Maybe one question related to that. In the French system, it seems that, the regulations are quite difficult for the firms which want to restructure. More difficult maybe than in the States. Does it give an incentive to take care of the restructuring before it becomes a legal case?
Yeah, it's always the question as to when you get into you decide to face the problem and start a restructuring or a negotiation. And it is very important to see the specificities of French creditors. And it's true that we see more and more situations where some of the creditors are UK or American investors, and we see how different their reactions are toward difficult situations. We really see the cultural gap, and I remember that case last summer where we had, and that was a strange situation, but we had a Canadian shareholder with French banks, and we were trying to negotiate the restructuring of the debt to enable the shareholders to have something back. And that Canadian guy who arrived in France and started talking to the bank and said, okay, I understand that you want to raise the interest rate, you want to make more money, you want to convert into share equity, so I'm going to give you all that, but you need to make very strong efforts. And the banks were so shocked by what he said, because it's exactly the contrary to what they want. French banks tend to have a trauma against what exactly Jean-Louis said, that is de facto management, about rupture abusive de crédit or soutien abusif, and their perspective is not to make more money, is not how can I take advantage of that situation, making a good investment, is just how can I get out of this and quick. And we are facing situations quite new for France, where we have that UK or US investors starting to come over to France, buying out credits over French difficult businesses, and trying to apply the US methods to the French situation. Up to now, I cannot say that it has created a strong evolution of the French mentalities and of the French practices, but it is a more and more current situation, and it will have an impact on the future. And it is true that this is something that can be done in insolvency situation, and things change dramatically when the company really goes bankrupt and file for redressement judiciaire, in which case creditors tend to have no role at all in the solution. So yes, there is a clear advantage to take things as soon as possible, as early as possible, because you have much more abilities to do things before going to court.
Yeah, I agree with everything Guillaume said, but you still need to gameplay it, because it works in many ways. I mean, I had the privilege of being counsel to the bondholders committee in Bulle, quoted debt, largely Anglo-Saxon investors who'd acquired the debt, who went to a company and did a a solvent restructuring in which the debt got converted into equity. That kind of recapitalization in France is not unheard of, but is very unusual. For the company and its advisors culturally, the thought that they had debt holders who actually wanted to interact with the company, who actually wanted to invest, who actually were prepared to put fresh money in, whether as debt or equity or anything else, was a novel experience, and not a very comfortable one, simply because it was not something that they had seen before. So we see that more and more, and one of the phenomena recently which has been increasing is, until now, to the extent we've seen these types of, let's call them Anglo-Saxon practices, they've concentrated on bonds which are readily tradable. We now see a lot more gross bank debt, in other words, syndicated credits, being sold at a discount to outside investors who come with different perspectives. Now, if you want to play that game, as Guillaume rightly said, it gives you an advantage, because effectively you're way upstream and you can cut up a debt with the company whilst it's still solvent. But you're really playing a very binary game, because if the company goes insolvent, your debt is probably worth close to zero, if not exactly zero. So you're playing a game of dare effectively with the company, and the company is forever looking at a balance of advantages and inconveniences. Do I file this or do I not file this? And a lot will depend on the type of business with which you're dealing. Clearly, a service business that needs to demonstrate credibility to customers over the long term will probably be more willing to negotiate with financial creditors while still solvent. Conversely, a business with heavy assets, because of the way French insolvency law works, management may have a built-in advantage to going into a plan de continuation. But beyond that, purely from a financial perspective, one of the problems of doing a solvent deal is we have a lot of so-called privileged debts here. So you can come into a company and offer X cents on the dollar, but a variety of so-called social partners, which are either the employees or more typically a variety of government agencies on behalf of the employees, will have the right to be paid in full within a relatively short period. That means that no matter what you do, you can't clean up the balance sheet as radically as you can clean it up on a proper insolvency. So de facto, what it means is that the total cost of your business is going to be higher. The advantage is that you're more likely to be the only buyer and therefore to be able to get everything on terms that suit you. So each case has its own advantages and inconveniences. I don't think it's possible to say that from a buyer's perspective, there's necessarily an advantage or an inconvenience in doing a solvent or an insolvent deal. Each has their balance of advantages. From a, let's call it, seller perspective, on the other hand, the world is a very different one. French insolvency is a nightmare if you're the manager or potentially the investor or potentially the bank. You don't want to deal with the potential civil or criminal liabilities. So very often you will find French partners who will go very far to avoid going into insolvency. I mean, for instance, to take cases that are far behind us, in the late 80s, early 90s, half of the press universe was going insolvent. And the big houses that owned newspapers were perfectly happy to sell them for negative amounts. You could buy a newspaper for minus 100 million francs. In other words, the seller would inject 100 million francs and sell it to you for €1. Now, those deals typically reflect the very issues which were initially raised by Jean-Louis, namely, if the business goes bust, will I get stuck with liability? And from a seller, an owner, a banker's perspective, the only way in which you can achieve a high degree of certainty is through a solvent deal. If you go into insolvency, it's basically a bit of a gamble.
When we look at businesses in difficulties, obviously very often we think about whether we should go in a deal before the bankruptcy, or if we should look at it in court. And there are basically three simple criteria. How many liabilities, as David said, we can clean going to court. That's one thing, obviously, and we need to take consideration for that. But the two other important aspects for us as potential shareholders, majority shareholders of the business, is whether we are competing in court with other buyers, obviously, which would be the case very often. And the last, most important thing is the business. You know, a company that is turned around and recapitalized in a mandat ad hoc before going to court is, you know, a different story for us and a better story for us than a company which has gone through the bankruptcy law, because the managers are totally devastated. The clients no longer buy the products, the suppliers no longer supply the products, and it's a totally different business. So we need to, and totally different business plans. So we need to balance all these aspects all the times, one against the other, and make a decision. And that's not always easy.
One last question. We talked a lot about the French law and not so much about American Chapter 11. Well, the French law seems to have some drawbacks. From, again, what I saw concerning Chapter 11, it seems that in some cases it lasts for years. We mentioned previously 18 months, but I saw, I think, cases lasting for 10 years. So, Shai, do you have anything to say about comparing maybe, or just telling how it works differently on the advantages and drawbacks of the American law compared with the French one, say?
Absolutely. The history of cases, or the length of cases, I should say, is really, I hate to characterize it, but really a political issue. And cases very often used to last into years. If you take large retail cases, for the example, Macy's, you know, large retail apparel store, they would file. You would figure out what was wrong with the underlying business because you knew you could deleverage the balance sheet. And for a retailer, the only important time of the year is the Christmas holiday season. So you would take Macy's through a holiday season, and it would take several months to download the information and figure out what you have fixed and what you haven't fixed. You'd have to go back operationally, maybe new product, maybe fix your inventory, fix your distribution chain, and then you'd ride through another Christmas season. And it was an evolutionary process, and it was very well accepted. But because of political sentiment that it was taking just far too long, judges have been much more activist in pushing cases along, and I think we right now are at the point where cases are 12 months to 18 months. And to take the examples of Enron and WorldCom and Global Crossing, I mean, these are the largest cases filed in history, and all of those were confirmed in just under 2 years. So I think that has been a dramatic shift, and there's an even it's going to swing, the pendulum will swing even further if any of the current legislation before Congress is passed, because right now a debtor, a company in Chapter 11 has 120 days to propose a plan of reorganization. It has the exclusive right, and that's really an issue of control, because our process is so very different in that it's very creditor-oriented, and we immediately have a creditors committee that bargains for all of the creditors and is very active and has a huge voice before the court, has its own lawyers, its own bankers, does its own diligence on the company, but they don't have all control, because the debtor still has, the company still has the right to propose a plan of reorganization, and it's 120 days, but it's subject to continual renewal for cause is the standard that must be presented to the court. And legislation before Congress right now will curtail that. I believe it's 120 days. One time you go back and ask for another 90 days, and that's it. So cases will become even quicker. But the larger differences that I see just from what I've heard this afternoon really deal with the liability to the individual creditors for extending credit, and perhaps the liability to management boards of directors and shareholders, which are, certainly the directors are protected by what we call the business judgment rule. At the time the decision was made, if you had all the information before you and were asking the correct questions, the fact that your determination was later on proven to be incorrect doesn't matter. You don't have liability. Same with a bank. You can't extend too little or too much credit. The issue is one of lender liability, which is the bank control of the company. But there it's real actual control. Were you making business decisions? It's not one of extending credit or cutting off a credit line. The process is so very creditor driven, and the process usually results in a conversion of all of the debt on the balance sheet to equity, and the debt holders become the new equity. And as a result, a lot of funds take positions very early on now in the secondary market, buying up debt claims to see if they can get a position at the table before a formal restructuring. But it really doesn't matter to them, because if they end up in a formal restructuring, they do get a seat, a very significant seat at the table, and they eventually will get to own and operate the company. And that's now a very profitable business model for any number of funds in the U.S.
I think it's very interesting to hear you, as an American lawyer, tell us about U.S. Chapter 11, because we have been, in the last months in France, having a lot of discussions about how can we create a French-style Chapter 11. Our Minister of Justice considering that U.S. Chapter 11 was the model for insolvency proceedings. And now we have a process of reforming French law, and the minister said that we were going to implement a French-style Chapter 11. So it's bad news to hear from you that in the U.S. Chapter 11 has been through specific critics. The good news for us is that the reform that is that is going in France now has nothing to do with Chapter 11, as anyway the French legal system is so different to the U.S. legal system. It is impossible to have something like a Chapter 11 in France. The good news is that the new law should be interesting. It should I have mixed feelings toward it, and I would say it will introduce new possibilities, probably help us go through restructuring, but at the same time make things much more complicated. And this is something we will have to keep in mind, try and simplify and shorten things as much as possible, as in many situations, in many restructuring situations, time is of the essence, and it's really at the same time very difficult and very important to have things wrapped up rapidly.
Yes, I mean, one of the interesting things of the new French Chapter 11, in inverted commas, should it ever be adopted, because for the last year and a half they've been telling us in the next 3 months we'll propose it to Parliament. So hopefully it will be passed before my children graduate from high school. I still have to have any children. Not as far as I know. But on a more serious note, one of the big impacts of this legislation, if it ever gets passed, is that at the moment there's sort of almost a magical duality in French insolvency law. You're either before filing or after filing, and they're two totally separate universes. And as I was saying earlier, for instance, if you buy debt pre-insolvency, you're really taking a gamble that you'll manage to do a restructuring and that you'll manage to get it restructured before it files. And conversely, if you want to wait afterwards, there's no point in owning debt. It's not going to be worth anything. It doesn't vote. Well, to some extent, one of the key impacts from a game-playing perspective of the new legislation is that it's not going to matter that much from a creditor's perspective whether the company has filed or not, because he will have a say, not as big a say as in the US, but some say in how the company gets handled. And the issue of converting debt into equity will become real, which is not the case here, not once a company is filed for insolvency. So one of the potential impacts, and like Guilhem, I share a lot of reservations about this draft law, but one of the potential impacts is that it could de-dramatize the moment of insolvency, and it could actually render the market for secondary loans a lot more fluid in troubled companies, including troubled LBOs, simply because people will not have to deal with the risk that from the day to tomorrow, as a result of a filing, their debt could be worth zero.